Understanding offtake agreements, a comprehensive guide. Offtake agreements are essential contract mechanisms in various industries, primarily dedicated to ensuring a reliable exchange between producers and buyers before production even begins. These agreements can have a significant impact on financing, pricing stability, and supply chain management. This article will delve deeper into the intricacies of offtake agreements, their types, benefits, and special considerations. What is an offtake agreement? An offtake agreement is a legally binding contract between a producer and a buyer, in which the buyer agrees to purchase a certain quantity of goods that have not yet been produced. These agreements are vital for companies in capital-intensive sectors, such as energy, mining, and agriculture, where upfront investments and project financing depend heavily on guaranteed sales. The agreement typically outlines critical details, including the purchase price, quantity, delivery dates, and quality standards, thereby providing both parties with clear expectations and a roadmap for future transactions. Key takeaways. Offtake agreements are contracts to buy or sell goods that have not been produced yet. They facilitate project financing by providing sellers with a promise of future revenue. Such agreements are often negotiated before production facilities are built. Buyers can lock in prices and guarantee supply well in advance of market fluctuations. Understanding the importance of offtake agreements. Financing projects. Offtake agreements serve as a significant financial instrument for producers. By securing these contracts, sellers can demonstrate to potential lenders that there is demand for their product even before the production begins. This assurance can lead to improved loan terms or increased financing options, as lenders are more inclined to invest in projects that show promise of cash flow. Market stability. In volatile markets, such as energy or commodities, offtake agreements provide both sellers and buyers with a degree of price certainty. These contracts can protect producers against price fluctuations, allowing for more effective budgeting and financial planning. For buyers, offtake agreements prevent potential price spikes and supply shortages, thereby ensuring access to necessary materials or products at an agreed price. Special considerations. Force majeure clause. Many offtake agreements include a force majeure clause, which absolves one or both parties from liability in events that are beyond their control, such as natural disasters, acts of terrorism, or war. This clause serves to protect both parties from unforeseen circumstances that could prevent them from fulfilling their contractual obligations. Default clauses. Offtake agreements also typically contain default clauses, outlining recourse options should either party violate the terms. These clauses include penalties for non-compliance, ensuring adherence to the agreement stipulations. Types of offtake agreements. Offtake agreements can take various forms, depending on the needs of the parties involved. 1. Hedging agreements, designed to protect against price volatility. These agreements set minimum and maximum price thresholds, enabling producers to manage financial risks effectively. 2. Take or pay agreements. In this arrangement, the buyer commits to pay for the goods regardless of whether they take delivery. This provides a revenue guarantee for the seller even if the buyer ultimately decides not to retrieve the goods. 3. Long-term sales agreements, typically spanning several years. These contracts aim to secure a steady supply of goods at agreed-upon prices over an extended period, benefiting both parties in a fluctuating market. Benefits of offtake agreements. Revenue guarantee. Offtake agreements provide a predictable revenue stream for producers, facilitating better financial forecasting and planning. Reduced risk. By securing a minimum price and guaranteed orders, producers can reduce their investment risks significantly. Market lock-in for buyers. Buyers benefit from fixed prices, which can protect them from future market increases and ensure consistent supply. Can parties break an offtake agreement? While offtake agreements are legally binding, they do allow for certain exit strategies. Parties may mutually agree to terminate the contract by paying a cancellation fee. Additionally, unforeseen circumstances that fall under the force majeure clause may provide grounds for cancellation without penalties. Interrelation with supply chains. Understanding supply chains is also crucial when grasping the context of offtake agreements. A supply chain encompasses the flow of goods and services from raw material suppliers to end consumers. Offtake agreements play a critical role in these chains by ensuring that producers can effectively plan their production schedules based on guaranteed demand. The actions of one company within the supply chain can have significant ramifications for the others. By securing supply through offtake contracts, businesses can ensure greater stability throughout the entire network. Conclusion. Offtake agreements are a powerful tool for both producers and buyers, fostering financial security and market stability in various industries. By guaranteeing future sales, these contracts enable companies to secure the necessary funding for projects that can otherwise be risky and capital-intensive. Investors and stakeholders alike must recognize the significance of these agreements, as they not only facilitate smooth transactions but also play a vital role in shaping market dynamics and supply chain effectiveness. Understanding the nuances of offtake agreements is essential for anyone involved in sectors that require significant upfront investment and management of future supply and demand dynamics.